Greetings, welcome. Thank you for joining us today. We're super happy to be broadcasting live from Park City, Utah, Los Angeles, California, the Bay Area, and somewhere in the islands of Hawaii. So we're continuing our partnership with Mercury and our good friend Shelley, and have really enjoyed getting to know some of the firms that are using Mercury as a banking facility. And it's far, far more than that. We'll talk a little bit more about that later, but we're super enjoying the opportunity to get to know some of their customers in the context of firms that would appeal to, and the family office investor community would like to get to know. And Suman and AiSprouts VC joined us on a call with a couple of other of the folks that will be also having singular presentations in the coming weeks. And so again, Shelley, thank you. Super glad to be enjoying not only our friendship, but our business relationship together. And we're really glad. Also today, in addition to Suman and AiSprouts, is a guest who is an investor in the fund, so we can hear directly from somebody who's been willing to vote with their checkbook and why they might do that. So why they had done that. So we're really glad to have everybody here. We have recording this, and we'll share it with you post webinar. We'll also put you in direct touch with Suman if you care to be an investor and learn more. And of course, our agenda here is to talk about Suman, and also for you to get to know Mercury if appropriate as well. Full disclosure, we're a customer as well, and we've enjoyed being one. So there's a little commercial. Throughout the webinar today, if you have any questions, please post them to the chat or the Q&A. We're not going to have you speak on the program, but we'll definitely get to as many of the questions as possible. We got a lot of folks coming on today, so we'll get to as many as we can, but feel free to post them as they come to mind, and we'll get to them in that order. And also, if there's anybody that you think would enjoy hearing what you hear today, you can get the recording on either the Family Office Insights YouTube channel, or perhaps Suman will post it somewhere on their website. And feel free to communicate directly with them. So with that, Shelley, you want to open us up here?
Yeah, absolutely. I also want to quickly introduce my colleague Puya, who's listed as me, but his name is Puya, and he'll change his name on Zoom.
There, you changed it. Yeah, good.
Yeah, there we go. Hi, everyone. Thank you so much for joining. My name is Shelley. I am a director of relationship management at Mercury. I work with scaling high growth, venture-backed startups and companies, Series A+, getting further and further into the Series B territory. And my role is to connect them to opportunities, to banking, to advisory, and then also leverage my own background of network connections to enhance their experience on Mercury. So Arthur and I go way back through my past working in startups and accelerators, and really excited that we could make this opportunity available through FOI to the Mercury community. We also do bank family offices, VCs. We have a number of features that are dedicated to VC clients. And my colleague Puya is specifically working primarily with our VC clients and their unique needs. I'll give him a couple minutes to talk about that.
Good morning, everyone. As Shelley mentioned, Puya, part of the relationship management team here at Mercury. Been here for about almost a year, and primary focus is working with our investor cohort, specifically the emerging managers, such as Suman, and getting our emerging managers in front of opportunities such as the Family Office Insights opportunity here today, and building the network and really establishing a Mercury brand within the ecosystem of the startup ecosystem. So excited to be here. Thank you for having us.
Thanks, Puya. Okay, Suman, you want to
Great. Yeah,
Nice.
perfect. Thank you. Thank you, Arthur. Thank you, Shelley. Thank you, Puya, for having me on. Just brief introduction, and then let me know when I should get into the deck, though. Right, this is just the setup. But yeah, Suman Talukdar. I manage and run this boutique Silicon Valley venture fund focused on AI, which is AiSprouts. Have been investing on thesis since 2020. Which is when really AI became more capital efficient. And looking forward to telling you more about what I'm up to. I will just briefly have one of my LPs also introduce himself, and then I'll get into the deck. Vera, do you want to just briefly introduce yourself?
Yeah, hi, I'm Veerapant Sananikan. I'm an LP in Schuman's fund based out of Hawaii.
Perfect. Thanks, Vera. All right. So the way I thought I'd set this up is, I'll plan to get into about 20, 30 minutes of overview. I can't actually see if I can see the Q&A. Yeah, I can't see it. I can, if you have questions that come up, just to make this a little bit more interactive, if you could either put them on the chat or send them to Shelley, that'll help me kind of guide where I should go. But really, I hope that you have a clear sense of what we're doing here with the fund after this discussion. I am raising, so I'm closing my second vehicle now, about half subscribed, looking to fill the last probably 2 million. I've carved out 2 million for institutional investors, and the minimum is 100K. So if you're interested, obviously would be great to chat. But more importantly, with these conversations, I look to really build out the community and the ecosystem that supports the fund. So as an introduction, so AiSprouts is, like I said, a Silicon Valley-based boutique venture fund. I focus on what I call post-traction AI companies. So these are companies that have some sort of demonstrated revenue or product that's delighting a customer. And I'm predominantly investing in products and services that I call are advancing human potential. So think about this new digital fabric that's being constructed by AI that's going to be the operating system for humanity. There's lots of different companies that are popping up, and I'm investing in these. And so typically they're in the seed stage. They have some sort of Silicon Valley story. The majority are based here, and I co-invest with the best funds. So I have about 12 to 20, a couple of dozen different funds that I collaborate closely with. And the result from the first fund so far have been, this is a 2020 vintage, 27 investments. Those companies have raised north of 150 million in follow-on capital. So amazing growth there. The markups between my investments and the latest rounds have been anywhere between 5 to 22 times. So clearly validating the ability to get some really amazing value, capture some value. And so now the second fund, which I'm closing, is basically repeating the same thesis, slightly larger check size, and looking to replicate the same results. So I'm going to get into more details about exactly what that is. But before jumping into it, I wanted to kind of give you a sense of the team. So I was the founder. I've been a Silicon Valley investor and operator now for almost a decade. The unique sort of perspective that I bring comes from now this AI track record, because I kind of spotted this thing happening early. Experience working with amazing people from various unicorn roles, and then previous private equity background. With the AI track record, now with the first fund, there's over 30 different portfolio CEOs that I work with on a daily, weekly basis. This has given me amazing perspectives into what really makes this space work. And then early on in my career, I actually built a lot of this stuff when I was research. One of my early mentors who's now involved with the fund, was one of the founders of Siri, Adam Chire. And as I progressed in my career, I was able to see really what made some of these amazing companies successful. I was fortunate to be involved with 3 that were experience amazing growth. One's Cloudflare, currently, at one point it was 50 billion market cap. Now it's at 20 billion. I joined the company as it scaled up, employees about 6 times. Anaplan recently went public, but I saw it through its IPO of 2.7 billion. And then Clearwell was really the first company I was involved with. This was post the financial crisis at an exit to Symantec. So really kind of this network that I curated from these experiences is what I bring to the table. This rounds out kind of a broader network that includes a great network, Ivy League schools, et cetera. And then previous work that I'd done on innovation theory that really expanded my access to, I think, insights that other people don't have. So briefly, just to, and Veerapan can give you a sense of the type of, LPs that are attracted to my group. The network really attracts the best of the best. The core advisors include Adam, who's now, sold his 3rd company to Airbnb. First 2 were Siri to Apple, Viv to Samsung. Forrest is an advisor, mentor for 20 years. He's a Rice alum. He's been at NEA for a long time, has seen a lot of these cycles play out. And then broadening out with Michelle and Louis, this really is this network that includes, amazing founders, executives, GPs at other funds, contacts at academic institutions. And obviously now after 2 funds, my LP community, which includes, former founders and VCs from firms, including, Kleiner, et cetera. So just to give you a sense of what really attracts, folks beyond just the investment returns to really join the community, I invited Vera here, who's been with the fund since the early days. And he can give you a little bit of a sense for, his experience so far.
Cool. Thanks, Suman. Hi, everyone. So, earlier, I'm Veerapan Snanakan. I'm an LP in both of Suman's funds. I have north of about 6 figures invested in both funds, and I plan to add more to my positions via SPV, to double down on some of the fund's investments. A little bit, about me. So I'm an alum of Columbia Business School, worked in finance on Wall Street, spent time on the buy side at Dresdner Bank's investment management division. Also spent time doing mergers and acquisitions for JP Morgan. Then after that, I left finance, founded a couple of successful companies based out in Hawaii. I decided to invest in AiSprouts, mainly for 3 reasons. The first one was, access to AI opportunities. I was drawn to the funds because it gave me, access to AI companies that were kind of reshaping, various industries across the economy, to kind of expanding my networks. Admittedly, I spent a lot of time in New York, academically and professionally, and my connections are mainly in finance. And so, however, with Suman, I've been connected to other LPs in the funds who are founders, operators, investors in Silicon Valley. There's also, in-person networking events, which I, plan to attend. And then the third, reason why I decided to invest was that there's great allocation as a co-investor. So, through his relationships with founders and co-investors, Suman has available allocation in insider-only rounds. So in a nutshell, 3 main reasons. One is highly exclusive AI investment opportunities. 2, expand, my network within Silicon Valley, and then finally, we get great allocation as a co-investor. So, happy to connect offline with anyone that may be considering an investment. Thanks.
Perfect. Thank you, Vera. Thank you for that. Just really briefly, before I keep going, just to answer a couple of questions. 80% of the companies I've invested in are based here, but given that a lot of companies are now growing virtually, I'm open to companies whose founders are in other places. So that's led me to investments with teams in Massachusetts. Obviously, there's the Harvard, MIT hubs there. I have a couple of portfolio companies in New York. but they either have, you know, an investor or an employee that's based in Silicon Valley, and that's the geographic constraint. I'll get into exactly what I define as, you know, an AI company. But in the first fund, it was very much the semantic I used was machine learning, and there were companies that were applying machine learning. And obviously, you know, since then the software stack has evolved quite a bit. But I'll get into that. So, you know, why get involved with this group with folks like Vera? You know, I think we're in a once in a lifetime, once in a, you know, history of humanity moment where like you're really talking about automation and like artificial intelligence blossoming, and it's basically a tipping point of this massive opportunity that's emerged. I think the wave's going to be bigger than, you know, what the internet was, bigger than what SaaS was. It's going to envelop everything. It's dramatically changing the underlying technology stack, and it's happening very fast. Empirical proof can probably be market sentiment towards NVIDIA stock, if you want to look at that over the last couple of years. But it's this $1 trillion paradigm shift towards what I call automation. And it's happening because, you know, algorithms that have been around for a long time, they were researched before, they've become off the shelf. They're available via open source. Data, which is the underlying kind of ingredient to build really AI systems, there's more of it available. You can store it anywhere you want. The economics of data have changed dramatically. And then finally, the real why now moment is the computational power. So, you know, NVIDIA, basically, if you look at just what it's done, the GPUs have improved 1 million times over the last decade, and 1 million times are projected over the next decade in terms of performance. So you're talking about 1 trillion times of horsepower that's coming into something. And that really doesn't happen a lot. And so since 2020, basically nobody predicted how much computational power would really blossom and perform. And that is the moment we are in today. So what I focus on is investing in founders and companies that are building products that's making these artificial intelligent applications a reality. And you know, the abstractions that are coming from GPT, the paradigm, are just the beginning. I think it's an example of how it's going to become easier and easier for you to build really, really intelligent systems. So the plan is, you know, if you envision where we were in the cloud in 2009, imagine if you had the opportunity to invest in the 100 best ideas between, call it 2009 and 2019. That's the pattern that we're pursuing here at AiSprouts. So between 2020 and call it 2030, I believe that there's going to be 100 amazing companies that are popping up that nobody ever even thought of. And we're investing in those ideas and in those companies with the hopes and the aspiration that a handful of those will become the next kind of $1 trillion unicorns. So that's a bit of kind of the thesis, the big vision. The way that I separate the outstanding companies from the ones that would do okay is actually an ingredient. It's an approach that I've refined over the years. And the first part is really focusing on traction. So that keeps me away from taking a lot of technology risk. So I call it science fair projects, and which can work out fine, but I'm less patient about waiting for those to flourish. So I really get involved with founders when they actually have some market proof. And so the recipe is 3. Obviously, people is number 1. That's what separates the great companies. 2 is getting involved with products with demonstrated traction. That typically is early revenue. Call it a few $100,000 of ARR in the case of software. Sometimes it could be a great usage data. Maybe it's an amazing pilot. I have stories from each. And then the last element is a competitive advantage to win the market. So really kind of machine learning as a data mode, something that helps them get increasing returns to scale. So how our fund is different. It's number 1, it's complementary to the lead. So, you know, once I find these companies, I don't necessarily look to be the first check. I look to be a complementary check to the lead investor. This leads me to have an initial check size that isn't too big, isn't too small. Again, market-ready technology, machine learning being applied as a superpower, and then bringing my life's work network. So just to wrap up this section, and then I'll get into kind of some of the companies, what founders access from beyond just the risk capital, which is the initial value add, capital introductions up and down, kind of the financing stream to folks like Mercury or other LPs or other institutional funds, basically to remove the friction that founders have in raising capital for follow-on rounds. Second is, from my experience scaling a lot of these unicorn companies, I understand the steps that companies go to as they try to achieve different stages of growth. So not only is it helpful for me to have that perspective, but the fund can actually help connect founders to somebody in a network of a 10,000 person network with the right person, right sales leader, right product leader that can help them get to the next stage. And then finally, these insights that come from these networks often helps companies, recruit advisors, board members, really help them clarify the key milestone. And all of this has come together through this community now that includes a founders boot camp. We do an LP CEO summit per fund, quarterly meetups, et cetera, to really mobilize and activate all of these great people interactions. So just to get into kind of where the fund is and the success we've seen so far, it's really ambition that has driven a lot of the founders to work with us and appreciate our support. A lot of these entrepreneurs don't just want to be successful; they want to really build something that lasts. And what they appreciate is the fact that I've been involved with some of these companies that have really scaled and can bring some of these perspectives to the founders and help access some of this human talent. So here are some examples. Hayden, they've raised 80 million to date. Initially, Hayden, and I'll get into what the company did, probably wasn't the most obvious play, but he really appreciated the insights I had from a lot of the funding community, folks like Autotech Ventures, who ended up leading the investment. Then there's Alex, who's enterprise software solution, really understanding of how enterprise software companies scale over time. That's what I've brought to the table. And in the case of Procyon, he was actually recruited his chief revenue officer through an introduction that I provided that initially started as an advisory role. And in the long run, these things may not sound that big, but when you are a seed stage founder with maybe a team of 3 to 8 people, bringing one key contact, one key relationship, one key introduction can really be a game-changing event for the company, and that's what I specifically look to do. So just to highlight, some of the fund one investments, the mix of companies has been everything from enterprise software, climate solutions. We have some, applied space technology, but the core, 40 to 50% of the time, the core is basically enterprise software. This includes, productivity automation solution. I have a sales forecasting company. Then on the computer vision, applied computer vision, there's this company, Hayden AI, we'll get into it, which is basically smart cities. I have some disaster relief technologies that's backed by Chris Sacco's, the lower carbon investor, ag tech, space tech. And all of these companies combined have raised, like I mentioned before, 150 million of follow-on capital. The largest has been 80 million by Hayden, followed by 40 million, and then I have a couple at 20. So really dramatic validation of market interest when the companies are scaling and they're growing. It ends up being about 800% year-to-year growth for those companies. And just to get into some of that in more detail, here you see basically the standouts. The 40% of the first fund capital has gone into these companies. I'll walk you through kind of how that works. But those 40%, that 40% can effectively be 3 to 5x return for the fund. I'm not going to promise when that happens, but if these companies continue their growth, they don't even have to have multi-billion-dollar decacorn exits, and the fund's doing just fine. And that's the value of having a boutique approach. So to walk you through it, Boost Up, it's a company that invested in 2020. They are effectively in the sales stack, think Salesforce. They came into market with a product that a competitor had raised about 150 million at the time to build a similar system, because they started in around 2012. And these guys came in at the time with, having raised 500K, and that built something similar. And so the company grew from, that initial seed round to raising 40 million. That was a 20x multiple. They've done about 5x revenue, and straight down the middle enterprise play. Hayden AI, a company I co-invested with Autotech, who's the leading kind of mobility and transportation VC. They, when I met them, this was at the beginning of 2020, COVID. The gentleman was coming out of Skydeck, which is one of the Berkeley accelerators. I met him, and I happened to know the lead investor, so everything came together on the round. And he had, one NVIDIA box in a bus in New York City. And what the company does is they actually use computer vision. They actually install them in the buses. There's about 1,000 buses around the world now that have the technology. This is all since 2020. And they're building digital twins of the city, and they can see everything that's happening. The first application is traffic enforcement. So for example, if you look at bus lanes, you don't want people that are illegally parked. So they're catching those, and they're expanding to lots of other things like school safety, et cetera. So they're effectively making cities smarter. This company just raised, the fund invested at a 7 million pre-valuation. There were SPV opportunities. Vera participated in a number of those. And that 7 million pre, their last round was at a 200 million post. And they're projected to be at 60 million in revenue. So that company itself will make the fund. Last two, Zero, it's a company that's doing basically automation for the enterprise. You have this new layer that's being created from large language models, and a lot of industries like finance, legal, accounting, insurance, they don't want to give that data out to the open AI or the open cloud. And so they actually want to have proprietary systems they can manage themselves that are very, very sensitive to the customer data. And so Zero has built that, large language model engine for the most, acutely sensitive industries in the world. And it's called Hercules. So that company is going to be raising a Series B. They've been growing at a nice clip, 3x in revenue, projecting the same the next year. And then finally, FormLogic is a company that, one of the few companies I invested in the Series A. They've raised 40 million to date, and they basically automate manufacturing. You bring in a part, you show it, you show the part to their system. It can be a CAD drawing, and then from there, they will automate the entire manufacturing process. So companies like SpaceX are their customers, and there's a whole geopolitical shift in terms of, highly precision manufacturing needs to happen domestically. So that company grew 15x in revenue. And the reason I like to talk about each one of these companies is that hindsight, each one seems very obvious. But if you had tried to predict which ideas you would see, it would have been very difficult. But that's the nature of the technology. It's popping up everywhere. And that's where this portfolio approach can really be powerful. So the way I kind of look to build my portfolio, this is a screen of snapshot of everything that's in the fund. It's a mixture. Everything is machine learning. So there's data that's training some model, and that model is getting smarter over time. You need to pay to train it. Over time, that cost declines, but the technology, the product becomes smarter. And it ends up being in three pillars. So call it, there's a traditional enterprise software, which is sitting on, corporations, and it hits, functions like sales, marketing, et cetera. And so that's about, mostly 40 to 50% of the fund. Then there's computer vision application where there's some sort of hardware involved. And again, hardware is not the core business, but hardware is an acquisition approach to actually capture data. And an example of that is what I mentioned, Hayden AI. Then there's other companies like Adaviv, who's basically building the Tesla for ag tech. I can get into that offline, but they're capturing all the data that exists from crops. And then there's retail, capturing all the data that's happening in stores. So that's the second bucket. And then the third is basically other. There's lots of different, other application verticals. and AI is coming into play. So in the first fund, there's some gaming investments that I've done. A16 is an investor in BashGG. Then there's fintech solutions. Obviously, transactions require a lot of like intelligence for monitoring, fraud detection. And then there's underlying building blocks that enables everything. And obviously you couldn't finish without a bit of robotics. I think what's happened is that, just as this AI stuff has become more capital efficient, the cost to build really intelligent systems has come down. And so in the first fund, I have a company called Tudor Intelligence with a couple of MIT founders, and they effectively for $1.5 million, they built this, completely automated robotic arm that doesn't require training, that can be applied to multiple industries for like $1.5 million. They got it to market in less than 18 months. And that's the kind of things that are happening now that even 5 years ago, you would have said it's unheard of. And that's what the fund does. It gives you access to this. So just to wrap up, and then I'll have hopefully some time, for questions. But the way that these and there's not a lot of people who've seen this data, so this should be pretty insightful. This is kind of the typical pattern for what I call automation all-stars. So these are the AI companies that are really working, right? And it's different than the previous, call it 1.0 SaaS paradigm. And I'll explain to you why. So this data is based from my 3 investments that are now at, call it that Series B stage. And typically these companies start with a pre-seed round that's 1 to 5 million. That's, call it your friends and family angel pre-seed fund round. That gets them to some sort of customer validation. It's either a design partner that's using the product. It's either a customer that's paying for it, some ARR recurring. And those companies then raise, call it a 7 to 20 million priced round. That's anywhere between 2 to 5 million in total. And so the target sweet spot that we get involved with is at the seed stage. So these are, we're building a portfolio of 25 to 30 companies that have raised the seed round. Now, after the seed round, what generally happens if the companies are working, like everything is, the initial thesis is correct, et cetera, they'll be gradually growing. And then there's multiple opportunities to double down, right? You get to double down on the winners. And so one opportunity is called the seed plus stage. Sometimes the companies realize that things are working really well, and they'll want to raise a little bit more before raising a bigger round at a higher price. And these are called the SPV candidates. These are the companies, these are the rounds that I love to bring to my LPs to invest in. And you're effectively cherry picking into opportunities that other people don't see. There's also the examples where, maybe the company's doing well and they just underestimated how much capital they need and they need to raise more. So you can also invest in that. I generally stay out of the situations where, you've been invested in the seed round, but the company, it's not working and they're trying to raise more. So you kind of have to you sit back from those. But this is the model. Then following the seed stage, the companies typically raise a Series A. They're anywhere between, call it, 50 to 90 million pre, 75 to 125 million post. And at that point, the company starts to scale. I double down in that if I have really strong conviction around the company, and finally ending with a Series B that so far has been anywhere between 150 to 190 million posts. So you're looking at anywhere between 10 to 20 times of value that can be created in a very short amount of time. And the way that we benefit out of the small fund is that we get to write small checks initially, get to know the company, and then really double down in the second fund. About 10% is the max. I'll double down into the winners. So in a portfolio about 25 to 30 companies, you're getting a mix of maybe 4 to 8 companies that are really stellar. And as an LP and as an investor in the fund, you're getting access to these, and you're getting to learn about everything that's really working. And the reason I'm able to do this as a small boutique fund is I collaborate. If people ask me what my superpower is my willingness and ability to collaborate with other great investors. And in the first fund, that's been everything from major funds that obviously are the follow-on investors, General Catalyst, Two Sigma. But then the initial checks really come from boutique funds that are specialists in their own sort of swim lane, and they've been doing it for a while. They might be slightly larger, maybe up to 100 million. And they're typically leading the round. And I come in to complement that round with, this network. They can also include specialist funds like Autotech, focus on mobility, Bootstrap Labs, who's typically been more of like the deep tech investor, 50 years, who focused on climate, same with lower carbon, First Raise Infrastructure, S3, who's thematically the largest Texas-based investor, but then, a lot of the companies have been growing everywhere. So that's the type of exposure that I give my LPs. It'd be impossible for one LP to invest, in all these different funds. But because I have this, laser focus on AI, I'm able to cut through a lot of this and provide that exposure, so that access, as was mentioned. So finally, to wrap up, what's the portfolio construction for the second fund? Again, I'm just doubling down on a strategy that's worked. By next year, by the end of this year, I'll be at about 40 plus investments in the portfolio. The metrics have been great. Like out of 27 investments in the first fund, only one of them had a early acquisition that wasn't really accretive to the fund. Everything else has been working. Like I said, I have some companies that are stellar, so the rest are growing nicely organically. So the second fund, same thing, 25 to 30 investments. The initial check size is 100K to 200K. I usually come in at 100K, I double down. That can be an SPV, an opportunity. And then if the companies are really working, they'll get up to $1 million, which is 10% of the fund. And for those of you that are familiar with kind of the venture model, the outcomes, as you know, come from the winners. So the amazing outcomes, they're going to be 40 to 100 times. If you look at the first fund, right, you already have one that's at 20x before at the Series B. The Series B investor is going to expect 3 to 5x from there. So that's 60 to 100x. The good outcomes are just return generating. You want to typically get consistently 3 to 5x funds. And the good outcomes just adds to the IRR. It can provide early liquidity, some distributions. And then the rest are just, the way I think about it is really build community, real build track record with founders. You give them nice exits, they're able to realize a story and then move on to the next one, and that becomes the next investment. But the unicorns are the ones that are driving the upside. So if you're looking for exposure to early stage AI, you're not going to get that in the public markets. Larger funds, their check sizes potentially are too big to really make a meaningful difference as a seed investor. So this is a vehicle. It gives you access to these seed stage companies that the stellar ones will be driving kind of the next generation of what is becoming technology. So the terms, like I said, I've closed half the fund. Working on my next close, probably later part of March, April, wrapping up the raise this year. And the target is $10 million. I've carved out, call it $2 million for a kind of anchor level, 500K to $1 million investors that I feel have some strategic assets that would be helpful for the portfolio companies. And I'm just doing as a way to scale. The rest of it, call it $2 to $3 million that's open, is targeted at high net worth individuals, family offices. I'm giving preference to folks who can do 250 plus. But I expect to be able to do 100K, and the capital call is 25% every year, starting this year through 2026. And you get a portfolio of, like I said, 8 to 10 companies every year. It's 25 to 30 total. After this fund, the portfolio will be about 50 companies. After a third fund, you're at 75. So again, I'm going after this 100 company mix of this theme, which is the dawn of AI. So anyways, I got into a lot of detail. I don't know how many people are still on, but I'm happy to take any questions so currently I've had some new markups that aren't there. The first fund is at one.
Hang on, Suman.
Oh, sorry.
Let's just be clear on the question. So the question is, what's the fund marked at presently?
Yeah, exactly. Sorry. So so first fund is currently at 1.25, but that doesn't include some of my latest rounds. I'm projecting it to be at probably at 1.3, and then after, I'll stop there. So that's the current mark, and then
go ahead.
Yeah, and then my SPVs, which is kind of a separate bucket, those are at 1.5, and But again, those are cherry picking into a portion of the fund's investments.
Fair enough. Is in every case, when you're investing the fund's money, it's directly into the company's shares, or are you participating in the fund that brought you the deal?
No. Direct. Co-investor is just meaning like we're collaborators.
No, I understand that. But
Yeah.
the fund deploys directly into the equity or however the structure is going to be, as opposed to through the funds like Kleiner Perkins to
Yeah,
get access.
no. It's not a fund of funds. Exactly.
Right.
I'm investing directly into the corporation.
And then the co-investment is through an SPV that you establish that people can get access to outside of the fund with the carry as your way to get paid.
Exactly.
Good.
Exactly. Yeah.
So if it's okay with you, let's run through some of these questions so we don't miss any. I know you answered a couple. Maybe you can just summarize it. Do you only invest in AI, or can it be companies with AI elements?
Yeah, that's an interesting question. So it depends what you define it as, right? So the underlying piece that I look for is the application of machine learning, right? So AI is the broad semantic, right? Within AI, you have, machine learning. And then machine learning, there's different implementations of machine learning, which is basically the application of like a neural network. So the products that I back are in some way or another using that. Now, with ChatGPT and large language models available via APIs, you can argue that those are AI elements, right? They may not be, they're fine-tuning the model, they may not be building the model themselves, and that's fine. But broadly, what I'm looking for is something is getting smarter because it's being trained by data. That thing that's getting smarter is actually a model that needs to be trained. And the cost to train that model is coming down over time. And not only that, but it's getting smarter because of computational horsepower. And that's the engine, right? That's like the engine that I'm looking for across all my investments.
Yep. And then you answered this pretty clearly in your page on where you invest and that sort of thing, but maybe another summary comment. How and when do you exit the companies that you fund? Are you involved in next stages, including a possible IPO?
Yeah. So when the exits, so the companies that work, typically meaning like they're highly successful, usually take at least 6 years, right, to go from seed stage to IPO, and that's the goal, right? Like we're trying to allocate capital into those types of companies. So in that example, where a company goes public, what happens is the funds, your ownership in the fund effectively converts into shares in the company. And I would just distribute those shares in kind to you as an LP. And you can then decide whether you want to sell it or not, right? That's kind of how it works. In the case of, a private sale where capital is actually distributed, I would just distribute the capital back. And that's how the exits work. In terms of my involvement as a seed investor, I typically am most active in helping them raise the A. And then once the A investor is involved, I may have some special relationships with Series B type investors at great firms, Insight, et cetera, that I have some relationships with that I can help facilitate that B raise. But it's effectively the A investors come in with a board seat and they're championing that.
Yeah.
And then after the B, it's effectively a passive investment if it's working, right? Like it's scaling, it's growing. You hear about follow-on raises, you participate based on pro rata, but there's not that much heavy lifting that you need to do. And that's what you want, right? Because the entrepreneur is just off to the races. So that's the way I think about exits and my involvement over time.
Yeah. So this is my question, and I don't mean to be controversial, but it's usually fun. Is the Valley still the place to find this stuff that you wouldn't otherwise be able to participate because of all the horsepower there?
Yeah, the way I think about it is the Valley's gravitational pull has not gone away, right? I think there's it's like here, and then there's lots of stuff going on around, but there's a lot of capital, there's a lot of key people, there's a lot of great talent. where you're seeing a lot of the stuff that you need to see. And that's the way I think about it. Where that talent physically is located has changed, and how people choose to tap into what's here is a personal decision, right? Like if somebody decides to move into University Avenue, I mean, I'm sure they're going to avail the benefits, right? But I don't think I look at it that way. I think it's pulling a lot of great information, great insights, great deal flow. After this call, I'm actually meeting with a team that I was referred to by Autotech, who's here, and they're actually flying down because they're meeting them at the office at Hayden. And then, but they're actually, the founder is based in Chicago, the other founder is based in New York, and they're going to actually come here and set up shop, right? So it depends on the founder, but there's amazing gravitational pull. And then with AI, what I'm seeing is it is becoming a really strong cluster here. What brought me out to Silicon Valley in the late 90s was the internet, right? And I kind of saw that whole thing happen. And then the cloud, YC was really a big driver for that. And I'm starting to see elements of that. And I think maybe in this wave, it's guys like me, a lot of solo GPs, micro VC funds are popping up, and they're driving a lot of activity. So I don't think it's controversial. I think it's just a new paradigm.
Yeah.
And we participate, Silicon Valley participates with other geographies.
Yeah. Super valuable insights. So let's do this. Vera, thank you for being with us, and Puya also. Suman, why don't you do a little wrap up comment, and then we're going to hand it to Shelly.
Okay, great. Thank you. Yeah, so first of all, thanks everyone for joining. Like I said, I think it's a very exciting time. There's this huge new thing that's happening, and we actually get to live through it. And whether it's my fund or somebody else's fund or another vehicle, I definitely encourage you to explore the space. And I think my fund gives you great access to the types of companies, and more importantly, the types of founders that are really shaping what the future is going to look like. And if you're interested to know what who those individuals are, just check out my portfolio. And I'm happy to answer any questions, but more importantly, I'm here to serve the interests of my portfolio companies and my LPs. And if there's anything I can do to help them, and if you'd like to get involved, please let me know.
Super. There was a few comments from the participants that definitely want to be in touch with you for the obvious reasons. So I appreciate the community participating as they have, and your comments driving that. So Shelly, please.
Yeah, thanks again, everyone, for joining. Suman and Arthur are clients of Mercury. And so I would like to share, if you have any questions about how Mercury is supporting the startup ecosystem and the LP founder investor ecosystem, please let me know. We have incredible companies that we work with, that we bank with, that we have exposure to. So if you found Suman's excellent pitch to be exciting, please reach out to Arthur, to me, to anyone. We want to continue to bring more of these opportunities to your community specifically. And if you're around tomorrow, we have another fund that will be doing a session, Teddy Blank from StartUp VC, focusing primarily on climate tech investments. Same time, highly recommend you joining or sharing with your network if you find that they'd be interested.
Perfect. Yeah, we're looking forward to that as well. Yeah. Thank you. Great job, Suman. And again, thank you, Puya and Vera, for participating, and look forward to tomorrow. And we'll make sure that everybody gets in touch directly. And as I always say, thank you all for sharing with us. The only thing you can't make more of, and that's your time. Thanks so much, guys.
Thank you so much.
Guys.
Thank you.
Take care.